A Moscow court has issued a decision that could unsettle the financial system the West has built over the past 80 years. On May 15, 2026, Russian judges instructed Euroclear, the Brussels-based clearinghouse that settles more than $1 trillion in securities every day, to pay 18.17 trillion rubles. That equals $200 billion. And here is the detail few are discussing. Euroclear is simultaneously attempting to gain access to $5 trillion of Chinese government bonds. One ruling, two crises, and a quiet countdown has begun. Here is the full context, because the numbers are crucial. When Russia launched its full-scale war in February 2022, the Western alliance froze roughly 260 billion euros in Russian sovereign assets. Most of it, about 190 billion euros, ended up at Euroclear's vault in Brussels. Since 2024, the interest generated on those frozen funds, roughly 5 billion euros per year, has been directed straight to Ukraine. Russia has not received a single cent. In response, Moscow went to court. The central bank filed its case in December 2025, and on May 15th this year, the Moscow Arbitration Court ruled in their favor for 200 billion euros. Euroclear immediately dismissed the ruling as legally unenforceable. But that rejection barely matters. Russia has already been acting on its threats in ways few anticipated. Since February 2022, Russian authorities have seized or nationalized around $50 billion worth of foreign assets, including factories handed to Kremlin insiders, subsidiaries sold for pennies, and banks stripped of their Russian portfolios, including UniCredit, Commerzbank, and Societe Generale. Euroclear itself had to release 3 billion euros to compensate European clients whose holdings were expropriated inside Russia. That was not charity, it was financial strategy, slow, methodical, and entirely predictable to those paying attention. One might think a Russian court issuing an unenforceable judgment changes nothing. European law does not recognize it. Euroclear keeps the money frozen. Life continues. That is the narrative European officials prefer. But it ignores the second dimension of this crisis. This dimension is the one that directly impacts your money and retirement savings. Euroclear is not merely a custodian of frozen Russian assets. Right now, it is actively courting China. This is a fact, not speculation. In February 2026, Euroclear officially partnered with Bank of China to use offshore Chinese government bonds as eligible collateral in cross-border financing. Last week, the Financial Times reported that Euroclear is collaborating with Chinese authorities to participate in the Bond Connect program, which would give European investors direct access to onshore Chinese government bonds. Onshore renminbi bonds represent a pool of assets valued at approximately 5 trillion euros. Euroclear wants a portion of that, a very large portion. Here is where the trap tightens. China is monitoring every move Euroclear makes with the Russian assets. Every single one. Beijing's central bank holds trillions of dollars in sovereign reserves, and Chinese institutions maintain enormous positions in global bond markets. The question on every Chinese policymaker's mind is whether what happened to Russia's 200 billion euros could happen to them. Could Euroclear freeze Chinese assets tomorrow if Washington decides Beijing crossed a line? The answer, based on recent events, is yes. Euroclear is not politically neutral. It is a Brussels-based institution operating under European Union sanctions law. When Washington and Brussels agreed to freeze Russian assets in 2022, Euroclear executed the order without hesitation. That is the institutional reality. Beijing sees this clearly. This is why the Moscow ruling matters far beyond its face value. Russia did not win 200 billion euros in a Belgian court. Russia handed China a loaded argument. The argument is simple. Western financial infrastructure can weaponize assets under political pressure. Euroclear froze 200 billion euros of sovereign funds and redirected the interest to fund a war. A Moscow court has now formalized the claim of theft. If Beijing links its 5 trillion euro bond market to this same infrastructure, it is accepting the same risk. Meanwhile, the 30-year U.S. Treasury yield recently reached 5.2%, its highest level since 2007. The bond market is not calm. It is pricing in persistent inflation, fiscal deterioration, and geopolitical uncertainty simultaneously. Citigroup warned yesterday that 5.5% could be the next target for the 30-year. A Bank of America survey found that 62% of global fund managers now expect the 30-year yield to hit 6%, a level not seen since 1999. When yields rise that quickly, it affects more than government borrowing costs. It reprices every mortgage, every auto loan, every business credit line, and every pension fund holding long-duration bonds. That includes yours. This is what links these two stories in a way that should concern every retail investor. The world's largest bond markets are beginning to fragment. Japan's 30-year yield just reached a record high. The United Kingdom's 30-year gilt yield hit its highest level since 1998. This is not solely a U.S. issue. It is a global repricing of sovereign debt risk Euroclear, the institution settling most of the world's cross-border bond trades, now faces a legitimacy crisis it did not anticipate. Investors need to understand something most retirement savers do not. The risk is not only in what you own, but in the infrastructure that holds it. A custodian capable of freezing 200 billion euros of sovereign assets overnight is the same custodian through which the largest bond markets operate. That represents a systemic concentration risk. The only assets outside this risk that cannot be frozen by a Brussels court or a Washington sanctions order are physical gold and physical silver held directly. China does not need to publicly reject Euroclear. No press conference or diplomatic communique is required. It can slow walk the Bond Connect negotiations. It can quietly accelerate the CIPS payment system, China's alternative to SWIFT, which already connects over 1,300 financial institutions across 109 countries. It can expand the mBridge cross-border digital currency platform, which currently handles settlement between China, Hong Kong, the UAE, and Saudi Arabia without relying on a single Western clearinghouse. It can route commodity payments through renminbi swap lines with African nations, Gulf states, and Southeast Asian trading partners. None of this requires an announcement. All of it is already underway. The Moscow ruling has given Beijing's technocrats another documented reason to continue. Every basis point the 30-year Treasury yield rises adds to the evidence that the dollar-denominated system is under stress internally while facing external challenges. China has been building the infrastructure for a parallel financial system, including the CIPS network and African renminbi swap deals, impacting the dollar's reserve status. The pieces are connecting faster than most realize. Thanks for watching. See you in the next one.